Hello friends, so welcome to this yet another video on Concept Capsule series. Today we are going to discuss a very important concept from the chapter Forex, that is Purchasing Power Parity Theory and Interest Rate Parity Theory as well. See, what is this Purchasing Power Parity Theory is all about? See, this theory says that one price should prevail across the globe, which means let's take an example here. This is India and this is US. Suppose in India, okay, let's say one computer is costing rupees 40,000 in India today. Are you all understanding? So let's take one computer as 40,000. The same brand, the same make, everything remains same. Okay, and the same computer cost $1,000 in US. Are you all understanding what I'm trying to say? Which means the purchasing power of 40,000, okay, the thing which you can purchase, the goods which you can purchase, for example, in our case, the computer, using the 40,000 rupees in INR with the same, okay, US based currency, you have to spend $1,000 to acquire the same computer. Are you all understanding? This is the present situation, which means the purchasing power of, can I say like this, the purchasing power of 40,000 rupees is equal to, okay, the purchasing power of $1,000, 1,000 US dollar. To put it simply, okay, as per this theory, okay, we can say that $1 is equal to, what is that? 40,000 divided by 1,000, because, okay, 40,000 rupees will equals $1,000 now. $1 is equal to 40 rupees. $1 is equal to 40 rupees as per this theory. Are you all understanding? Because one price should prevail across the globe, and this is what you get, the exchange rate, which means if you try to determine the exchange rate should be fixed in such a way that, okay, the purchasing power should be on par. See, globally, everything should be same, which means $1 will be equivalent to 40 rupees. Now, this is all about spot. This is all about spot price. Now, what happens after 1 year? After 1 year, the same example, you need to imagine what happens. I will give you one more input and then try to visualize. Say, after 1 year, I'll give you one data regarding inflation. The inflation, this is India again, this is US. Okay, the inflation in India is 10% and the inflation, okay, in USA is just 5%. Are you all understanding? Now what happens? Can you tell me, children, the same, okay, one computer, can you buy it using this 40,000 rupees which you bought last year? Okay, which means the first year? No. Why? Because the purchasing power of the money would have been diminished to the extent of the inflation, which means 10% inflation is there now. Okay, the goods would have become expensive, which means more INR, more money you need to pay to get the same good, which means how much I need to pay? 40,000 into 1.1 or 110%, I'll get 44,000, which means next year I can only buy the same computer by paying 40,000 or 44,000 or 44,000. Are you all having the clarity? Come to the US transaction. Here, the same computer can be bought by using $1,000, or the inflation will also come into picture. Inflation will be there. US inflation is 5%, which means $1,000 which I used earlier, I need to pay $1,050 now. $1,050, 5% inflation I will apply to the dollar. So dollar inflation I'll apply to dollar, and India's inflation I'll apply to INR. I'll get 44,000 will be equivalent to $1,050, which means $1, okay, is equal to, what will be the forward rate as per purchasing power parity? 44,000 divided by 1,050. I'll get 41.9 roughly. Okay, decimal rounding off, leave it 41.9 as the, okay, forward rate. This is called as forward rate, fair forward, theoretical forward, or fair forward as per purchasing power parity. This only, if you see in your material, you would have seen the formula. Okay, the fair forward as per purchasing power parity as per PPP is equal to nothing but, okay, spot into 1 plus inflation of home currency divided by 1 plus inflation of foreign currency. Are you all understanding? Now the quotation for dollar, okay, it is given in India, which means, okay, this is a direct quote. Foreign currency quotation is given for dollar. $1 is equal to 40, or $1 is equal to 41.9. All these quotations are in India now. So this is nothing but direct quote. So what we will consider is that spot into, which is 40 into 1 plus inflation of home currency. What is home currency for you? Okay, in some books, what there is some, okay, faculty or some book, what they use is an inflation of the foreign currency is there now. For that, they will use the base currency. They will use a name called as base currency. and this is home currency, the other currency. That will be very confusing. That's why I use this. Okay, very simple and straightforward. If you are in India, domicile is in India, na, 1 plus inflation of home currency, na, which country you will consider? India. So what is the inflation rate? 10%. So 1 plus 0.1, 1.1 divided by 1.05, 5% interest rate of foreign country. So US interest rate you will consider. Now you will get 41.9. Are you all comfortable with this? This is forward rate computation as per purchasing power parity theory. Now shall we move on to interest rate parity? Now, what does the interest rate parity says? Now, interest rate parity says that, see, there should not be any arbitrage opportunity, okay, in the exchange market for, okay, based on the interest rate, which means there should not be any arbitrage opportunity in the money market or in the currency market. Okay. For example, I'll just show you what it is. Okay. Technically, I'll just again explain. Don't worry. Here, let's say, for example, we have two markets available. Okay. Currency market and money market. What is currency market? The Forex market, exchange. Okay. $1 is equal to 40, like that. Okay. Currency will be traded. Now, foreign currency will be traded. Market where currency will be traded is called as currency market. And then there is money market. Money market, okay, is nothing but interest rate market where short-term securities, okay, interest-bearing securities will be traded is called as money market. Now, in the money market, what I see is that in Indian money market or India, if you see, the interest rate is 10%, and in US, the interest rate is 5%. Are you all understanding? See, I will just explain the crux of the theory, then I will explain how this is verified. See, in India, interest rate is 10%. In US, interest rate is 5%. Let's say in currency market, the spot currency, the spot exchange rate, this is spot rate, spot exchange rate, okay, for dollar, $1 is equal to 40 rupees given in the spot market, and the forward exchange rate, assume $1 is equal to 41.9. Why I take the 41.9? What is the sacred number? I'll explain everything later. See, if this is the situation, what happens? Okay, I might think two persons are there, assume two persons are there. One person might feel, let's see, sir, the money market, I can borrow in US. I can borrow at a lower rate. I can borrow at lower rate of 5%, and I can convert the, see, I borrow in US dollar. I convert the money from US dollar to INR. Then I deposit this INR in Indian country, right, India. Then what happens? I can earn 10% interest, which means I can borrow at a lower rate, earn a higher interest rate. Then I will reconvert, repay the interest portion. Then I will book the profit. This is what one person believes. Shall we verify? See what happens. Just listen. Okay, here I see that there is money market, there is opportunity for profit. What I do is that first step. Okay, this is first step. See, I borrow in US dollar. Assume I borrow rupee, not rupee. I borrow in dollar 1 lakh. I borrow right from USD. At what rate? At 5% interest rate prevailing in US dollar. What I do next step? I convert it. I convert into INR. INR using, when you are converting today or tomorrow or today. So I will use convert at 40, spot rate I will use and convert this 1 lakh dollar. How much money INR will be there in my hand? 40 lakhs rupees. 40 lakhs INR will be there. Now what I do? 40 lakhs, I put it in pocket. I go to bank and deposit in India. I deposit in bank. That's why I converted. Now, so 40 lakhs I deposit. Okay, at what rate? At 10% interest rate in India. Are you all understanding how the arbitrage process works? Thinking that I will gain from the interest rate. Are you all understanding? That is the thinking. What will happen later we will see. So if I deposit at 10%, how much I will gain? This happens today. All this transaction happens today, which means on spot date. Later, after 1 year, what happens? This 40 lakhs deposit will mature. How much it will become? 40 lakhs plus 4 lakh interest. So total 44 lakhs will be the maturity value of the deposit amount. Are you all comfortable? Next, what I will do? I need to reconvert. This I got as INR. This is INR. But I initially borrowed in what? US dollar. So I will convert and repay the interest and then book the profit. I'll book the profit. See where you started, where you borrowed US dollar. Now the profit also should be booked in US dollar. Now, so what I will do? I convert this INR back to, I reconvert back to USD. So 44 lakhs is there. When I reconvert, okay, I'll use spot rate, forward rate. Why forward rate? Because this is not the transaction happening today. When will you reconvert? After 1 year, which means you should take spot rate, forward rate, assume 41.9. So 44 lakhs divided by 41.9, you will get how much dollar? Okay, 1,05,000. Okay, rounding off issue, roughly it should be 1,05,000. Now next step, what I do? Okay, repay the interest. Repay the borrowing along with interest. If you say repay the borrowing along with interest, okay, what is that? 1,05,000 Okay, 1,05,000 minus 1,05,000, because 1 lakh I borrowed dollar, then 5,000 I need to pay interest as well. Then, okay, profit or loss will be nil. Are you all comfortable? This is so which means initially he believed that by taking advantage of the money market differential, the interest rate differential, I can make profit in money market, but that fails. Are you all understanding? Understood? This, yes. What really happens, I'll tell you. Then I'll explain the reverse working also. What happens is, in the money market, really he is making gain. There is no doubt that money market he is making gain. Across the country, he is making gain. Yes, because of the interest rate differential. But the problem is that whatever he gained here, he lost in the currency market. Here there is loss. Currency market, he incurred loss. Why he lost? Sir, where is this loss? You did not explain it. Don't think. Very simple. Initially, while borrowing, by converting the borrowed amount of 1 lakh, he converted at 40. While reconverting, okay, after 1 year, he had to reconvert at 41.9 and not 40, which means he had to pay more rupees to get $1, okay, equivalent amount of dollar, which means, okay, the dollar became expensive in terms of rupees. The dollar becomes expensive. Less number of dollar only realized after 1 year due to the premium, dollar is quoted in premium, the currency market. Are you all understanding? This is why, if you see, okay, the country in which the interest rate is lower, okay, that country's currency will always be quoted at premium in the currency market. Are you all understanding? And the country of which the interest rate is higher, will always be quoted at discount, which means $1 was 40. And in forward market, if you see, it has depreciated. Indian rupee is depreciated and USD appreciated. Here, if you see, Indian interest rate is higher than US interest rate, which means one market will offer you gain, now other market will offer the loss. Okay, which means these two exactly will offset each other. That is the price at which these two exactly get offset is called as interest rate parity price, okay, which we found out in the exchange rate forward rate. As per the interest rate forward, the 41.9 is nothing but, okay, the IRPT forward, interest rate parity forward, to put it simply, is spot into 1 plus interest rate of, what is IRPT forward? IRPT forward is nothing but spot into 1 plus interest rate of home country divided by 1 plus interest rate of foreign country. There it was inflation in case of purchasing power parity. Here it is interest rate. Now if you substitute it, the same number you will get 40 into 1.1 divided by 1.05, 41.9. Are you all understanding what is the importance of it? Now you will have one question, one more explanation to give here. Sir, in money market, you said that I'm gaining, but I can see it in a different perspective. I see just a currency market and I have different view. If I see the currency market alone, I see that dollar is quoted at premium price in the forward market. If you see that $1 is 40 in the spot market. If I see that $1 is 41.9 in the forward market, dollar is appreciating, which means more dollar you will receive. So what a person 2 say, this is situation 1, I told you. Now situation 2, what happens? Another person thinks that by seeing the currency market alone, let me buy the dollar today and keep it in hand. After 1 year, I will sell the dollar and I will make more profit. 41.9 I will realize for every dollar. Let me, okay, buy the dollar, keep the dollar in hand. After 1 year, let me sell the dollar at 41.9. I can make, okay, gain in the currency market. This is what he believes. From his perspective, let us see what happens. That also I'll just explain. So, for example, what he does, initially, he buys dollar. So, buys dollar, now what do? He, okay, sells 40 lakh INR, 40 lakh rupees INR, and buys 1 lakh, okay, this is 1 lakh dollar at spot. Why? Because today he want to get the dollar. He's seeing that dollar is appreciating, he's buying dollar. This is first step. Next step. Why 40 lakhs now? Spot rate will be used, 40 will be used. Today is happening now. The transaction which is happening today, you need to take the appropriate price in the spot rate. Now, after converting it to dollar, what he will do? Okay, he will put it in pocket. I will go and deposit in the USR, deposit in US, which means he, okay, sells the INR, buys the dollar, deposit in US, which means dollar deposit rate is what? Deposit at 5%, okay, for 1 year, which means this is what he does today. So today he sells the rupee, buys 1 lakh dollar, deposit at 5% in the money market, then goes to sleep. After 1 year, what happens? You see, this deposit amount will mature. So 1 lakh dollar is there. This will mature to what? 1,05,000. Okay, after 1 year, why 5% interest rate? So it will mature to $1,05,000. Agreed. Now he is based in India. He need to reconvert. Again, reconversion will happen, which means effectively not. Okay, you need to understand that reconversion in the sense. See here, what happens here when he sold 40 lakhs and buys dollar na, effectively you need to understand that here 40 lakhs means he borrowed money. Assume that because opportunity cost, okay, he may have 40 lakhs in hand, but still assume that he borrows 40 lakhs. He doesn't have anything. He borrows 40 lakhs locally at 10%. At 10%, this you understand. And then he converted into dollar and then deposited 5%, 1,05,000 he realized today. Correct? As anticipated, after 1 year, when he tries to sell the dollar in the exchange market, 1,05,000, this 1,05,000 at what price? Forward rate, dollar is appreciating. He is very happy. Why? Because he could sell at 41.9. Okay, when he exchanged initially, he had to exchange at 40. Now he is exchanging at 41.9. Let me calculate 105 into 41.9. Roughly around 44 lakhs. 44 lakhs. Are you all understanding? Now what happens? This 44 lakhs, can he everything put it into pocket? What he has to do? He has to repay the borrowing along with the interest. How much he borrowed? 40 lakhs he borrowed. How much is at what interest rate? Opportunity cost 10%, 4 lakhs, which means 44 lakhs minus 40 lakhs minus 4 lakh, 0. He earns nothing as profit. Are you all understanding? Which means either you come from that side or you go from this side. It doesn't matter. As per IRPT, if forward rate, one line summary of the entire discussion is, if forward rate is quoted as per IRPT, this is fair forward. This should have been the forward rate. See, now the three situation possible. I'll just show you. Quoted forward is there, and theoretical forward. Whatever we computed as 41.9 is theoretical forward. Quoted forward, assume three situations possible, okay, is less than say 41. This is 41.9 exactly as per IRPT, okay. And another case, this is 43. Three situations possible. If forward rate is quoted at 41, if forward rate is quoted at 41.9, or if forward rate is quoted at 43 rupees. Three situation possible. This is different. Quoted is forward now. When you go to the bank, just like share price, if you go to the market, you get a quotation price, right? That is price. Price is what you pay. This is value, what you computed, which should have been the value, theoretical value. Now, when you compare this, if you see the quoted forward is 41. If you see the quoted forward, 41 and 43. In these two cases, arbitrage will exist. Arbitrage will exist. This is, I call it as currency arbitrage, how to, covered interest arbitrage, how to compute it, everything we will see in another discussion. For now, you forget about these things. Where the quoted forward is as per IRPT, there will be no gain or loss. Arbitrage profit will not be there. Arbitrage opportunity will never be there. Are you understanding? If quoted forward is something different than the IRPT forward, of course, money market hedge we are going to learn. Arbitrage opportunity will be there, and covered interest arbitrage concept will be covering the arbitrage process. Now, if the quoted forward is as per IRPT, I told you no arbitrage. No? This is the crux of the IRPT theory. The IRPT says that you should fix the exchange rate in such a manner, the forward rate in such a manner that there exists no arbitrage opportunity. This I called as, okay, fair forward, IRPT forward. That is what is called as IRPT forward, which means you consider the interest rate differentials and okay, fix exchange rate, forward rate in such a way that there exists no arbitrage opportunity. That is why this 41.9 is also called as no arbitrage price. Anyway, this is all about purchasing power parity and interest rate parity. Hope you enjoyed this concept. We will discuss some other concept in the next video. Thank you.